All right, what's up, Mortgage Coach and Trust Engine community? Today we have Mitch Kider. We're going to be future casting compliance in 2025. Mitch, welcome to the show, brother.
Thanks, Dave. Good to be here with you.
Well, thank you for all the years that you've leaned into the Mortgage Coach community and now the Trust Engine community with leadership around how to do things right.
Hey, it's my pleasure. It's a good community.
Yeah, well, I'm just really grateful for you, brother. And for anyone that's new in the business and doesn't know who Mitch Kider is, or loan officers, you're like, hey, who's this Mitch Kider guy? This is the top compliance attorney, litigator in the mortgage space. Your CEO and your executive team absolutely either hires Mitch and spends a lot of money for great legal leadership, or they know of him. So if you're a loan officer, I always make the case that being compliant is just being professional and usually adds up to just doing the right thing and actually making more money. So there is a Mitch Kider playlist. So if you want to listen to more content and interviews I've done with Mitch, check that out. I'll put a link down below. So Mitch, let's get right into it. I surveyed more than a dozen C-suite executives and a few loan officers that I know that know you. They'll like respond to me after I interview and go, "That was really good. I'm forwarding that to my realtors, or I'm forwarding that to my executive team." So you're making a lot of impact with this. But everybody wants to know, now that we've had an election, we have a new president, we have a new team around the president. What are some of the things we should think about? And what do you think compliance is going to look like in 2025?
Well, I think compliance is going to look very different in 2025. At least compliance enforcement is going to look different. Compliance itself, complying with the laws that are in front of you, and as you said, doing the right thing, that shouldn't look any different at all, obviously. But do I think there's going to be a different shape on our federal agencies? Absolutely. I mean, the CFPB director will be out by June 20th, if not the morning of June 20th, which is Inauguration Day. It has become a very politicized, the CFPB, a very politicized organization. So the president-elect will have his choice as to who to put into that particular agency, either in a permanent or an acting role itself. And certainly you're not going to see an agency as zealous as this one has been. In fact, that's probably an understatement, to tell you the truth. I think that if history repeats itself and we look back to Donald Trump's first administration, you'll see that he put Mick Mulvaney in first, and there was little to no enforcement during that period of time. There was a change at a later point in time when Mulvaney left, and we got Kathy Kraninger, and there was some enforcement, but done on a fair level, quite frankly, looking at, whether or not there was an egregious or, violation and not making up the law itself. So you're going to see the CFPB change rather dramatically. You're going to see some changes on the GSE levels as well. You're going to see a new FHFA regulator. And I think there's going to be an emphasis that's going to say, all right, we've got to take Fannie Mae, we've got to take Freddie Mac, and we've got to prioritize it completely again. We've got to get it out of conservatorship. And that's definitely going to have an impact on everyone that's listening right now, because there are two issues. Number one, how do we get them out of conservatorship? And that's going to take a while. That'll probably take at least a year or two to have that all figured out and taking them out. And number two, if they are taken out and the government is out of the picture for the most part, maybe they'll have a wraparound guarantee at the end. How's that going to impact the credit market? In other words, is credit going to get tighter for your borrowers, for your consumers? And, the reality is, with a fully privatized Fannie Mae or Freddie Mac, it probably will get somewhat tighter as well. So, we have interesting things that are awaiting us. A lot of uncertainty. There's going to be a fair amount of chaos out there. How should you guys think about us as loan officers, as originators? I think Dave put it exactly right. Do the right thing. Don't start thinking because compliance enforcement has decreased on a federal level. Now we can start doing things that we have learned over the years, are unlawful. Don't do that.
So you said two things that I want to drill down on because I actually interviewed Brian Hale yesterday, and we talked a little bit about that. And his big concerns are part of what makes the 30-year fixed rate, one of the only countries in the world that has a 30-year fixed rate mortgage and makes it affordable is the fact that there's the government's involved. And the biggest value to that is their standardization. And by privatizing those, you've kind of got different, it impacts the standardization and that will impact the cost of mortgages. How do you feel about that? Do you really think it's going to happen?
Well, I think we are very unique. Our housing finance structure is very unique compared to the rest of the world itself. I think a 30-year fixed rate loan economically in and of itself doesn't make a lot of sense for a bank or for anyone else along those particular lines. It was created at a time when it was absolutely needed, and without the government subsidy effectively, and without the government standing behind it, I don't think a 30-year fixed rate loan will last. I don't know that I would get too excited about this particular issue right now. I don't think the 30-year fixed rate is going away. Certainly not going away on government loans where it's most important, on Fannie Mae, on FHA loans, on VA loans itself. It's not going away along those particular lines. And we'll see what happens with Fannie Mae and Freddie Mac, and we'll see, even taking them out of conservatorship, I don't think the government can just simply walk away and not play a role in them at all. Okay.
Yeah,
I think
agreed.
that would in fact wreak havoc on our housing market and the housing finance industry.
So, by the way, anyone listening to this, I also had a conversation with Bill Dallas a couple days, and Bill is predicting that we will see a lot more IMBs with 5-year, 7-year, 10-year interest-only ARMs in 2025. I don't know that if that's something you have any visibility on, but he predicts, that's traditionally been something that the big banks in their high net worth departments have a lot of interest-only 3 or 5-year or 5-year, 7-year, and 10-year, but he thinks that will actually become a big thing in 2025. Any
Well,
opinions?
I think he's right, actually. I think it will become a bigger thing in 2025. Let's put it that way. Many of those products obviously are available today, but come 2025, interest rates remain high as they are today. These are products that our consumers are going to want. And so, yes, I absolutely think that we're going to see an increase in it. We're in a market where these products, we're on the cusp of a market where these products tend to make a lot of sense. And there are a lot of things that the incoming Trump administration wants to do that may lead to higher interest rates, quite frankly, before they start lowering again. And so we'll have to play that by ear and see how that happens.
So one more question before we move off of this. It just kind of as a macro transparency, a lot of things that, I mean, we know Elon Musk is gonna be pushing for more transparency. Typically, CFPB has enforced through actions, not provided the transparency. How much do you think transparency will improve from a compliance perspective, from a top-down perspective? Any thoughts on that?
Well, on a federal level, there are a lot of compliance determinations that are made in secrecy. Okay. So you talked about the CFPB, and that's right. A lot of what they have done has not been transparent, and they don't like giving you information. Even when you sue them, quite frankly, you have to beat them in court to get the information out of them. When you look at FHA, for example, okay, FHA, there's a mortgagee review board that is made up of the top political figures or political appointees at HUD that makes up a mortgagee review board, and their sole purpose is to sanction FHA approved lenders when those lenders have problems. That meeting is completely closed door. Nothing that's covered by the Sunshine Act. It's closed door. You're not there. You don't see the deliberation. You don't see how that particular decision was made. But that is statutory. Okay. And that's not necessarily going to change right away because there are a lot of other issues. On the CFPB, from the CFPB perspective, yes. Do I think you'll see more transparency? First of all, I think the CFPB as an institution is somewhat at risk. So I'll start with that. Okay. I'm not sure what the Trump administration's thinking is on the CFPB, but if I had to guess, it is as we go to a level of government efficiency as we shrink this government, what role is the CFPB playing? Is it playing it in the right place? Is it doing it the right way? Why do I have a CFPB and an FTC, which is really the nation's consumer protection organization itself? And I think you're going to see, I think you're going to see the CFPB as it exists today somewhat at risk, especially in the first 2 years, since both houses of Congress are Republican, as is the incoming administration. And yeah, at a minimum, you're going to see more transparency. You may see more than that as well, is my point.
Okay. Well, I'm all up for transparency. I believe that transparency is a competitive advantage. So let's just move into, and everybody that I polled said, "Hey, what questions do you have for Mitch?" Is like, "Hey, what do you think the top compliance issues are of 2025?" And let's focus primarily IMBs. You know, if I'm the CEO, head of production, someone in the C-suite of an IMB, what do you think are the issues to be paying
Yeah.
most attention to, getting ahead of?
So from a compliance perspective, I will say this: the IMBs are not going to be in quite the same position that depository institutions will be in, because the depository institutions will be governed by their prudential regulators and, the CFPB to a certain extent as well. And I think that this administration is in a deregulatory mode, obviously, and I do think there'll be less enforcement that's brought by this particular administration. But IMBs are subject to state law, and they're LOs. The people that are online right now that are LOs at IMBs, you are licensed by states. And what happens when the federal government starts decreasing its efforts in compliance? What happens
Mm,
then is the states step it up. And states are very aggressive. They've been very aggressive, for quite some time now. They're going to get more aggressive itself. So I think the top compliance concerns in terms of who you should be most worried about, I would tell you there are two things you need to be most worried about, and that is state enforcement, and they can enforce most federal laws as well. Okay. And private enforcement, class action lawsuits. I've defended over the years, probably almost 200 class action lawsuits. And you're going to see a lot more of those cases coming up right now, because when regulators aren't taking actions, then private plaintiffs' attorneys step in to take their actions themselves. What are the top areas? Well, fair lending will always be on the top of the list. And you can see it today in terms of nonprofit organizations as well as individuals that are filing their suits on fair lending grounds, appraisal bias grounds, redlining grounds, pricing differentials, things along those particular lines. That's not going to go away. That's not going to go away. It may be enforced in a different way. It may not be the Justice Department that takes the lead in these particular matters. It may be an individual plaintiff's attorney that takes it on behalf of a class of individuals, or it might be a state that steps in. So fair lending, extremely important. The biggest regulatory issue, which I guess you can call a compliance issue, is what are we going to do about loan originator compensation? It's a totally unlevel playing field. Everyone is doing something different. And loan officers are moving from one company to another, and they're saying, I did this at this company, I did that, how come I can't do it here? You may see an effort. You may see an effort at trying to stabilize that, quite frankly. At the end of the first Trump administration, the CFPB director, Kathy Kraninger, was about to propose some changes to loan originator compensation, such as an originator could get paid lower on bond loans, things along those particular lines. I think there's a chance that those types of changes are going to be made during the course of this administration. But LO Comp, I have to tell you, a day does not go by without either someone or many people calling me up with loan originator compensation issues, just trying to figure it out, just trying to get it right, just trying to be able to compete with others for your services, for loan originator services.
yeah, I've been talking about loan officer comp the past 2 weeks because, I help a lot of loan officers be more successful. I work with a lot of C-suites rolling out technology, and most of them aren't winning. I mean, like, if you were to ask most, loan officers or executive teams, hey, are you achieving your production goals? The answer is no.
Right.
And then when you look at conversion, uh, credit report to close loan, the top 10% and top 20% have great conversion. Everybody else doesn't. And I always look at conversion. That's like your sales satisfaction score.
Yeah.
That's your, are you creating value for people? And I do believe that I don't know how to get loan officers to do it, but to take them through a process to right size their comp. And any thoughts on that? And because that's obviously a big topic.
It's a huge topic, and no one wants to be first. No lender wants to be the first that says, I'm going to right size your account, saying that to their loan originators, loan officers. No loan officer wants to be the first that says, okay, go ahead, let's right size my comp itself. And it becomes quite a problem. I mean, margins are thin. On production, there is some profitability now for the first time in 2.5 years. So there's some profitability out there, but not a lot. Margins are pretty thin. And, loan originator comp oftentimes can get in the way of whether or not you can make that particular loan, which is what's creating these loan originator compensation regulatory problems by loan originators saying, all right, I'll take less on this particular loan. I'll slot this into a different bucket and say this came from a lead from my lender. So I can take less on this loan and make it work. So my lender's making enough on the margin itself. It's a problem. It's really a problem. And, in terms of conversion or pull-through rate, I mean, that's the critical, that's the critical data point that tells you whether or not you're being successful or not, quite frankly.
Well, so I think that lenders being more transparent organizationally and start really scorecarding your loan officers based off of conversion, because conversion is truth. I met with a client, I delivered it. If you have a high conversion rate,
Yeah.
you probably have the right price. And
You
if
know
you
what?
have a low
Yeah.
conversion rate,
Yeah.
you probably, and the other thing I try to get the lending industry to think about is your product. Most lenders think their product, oh, it's government jumbo, 30-year fixed. And to me, the product is the customer experience. And, fits right into MortgageCoach. Like, if you're just giving a fee worksheet, here's your rate, here's your payment, here's your cash to close. Well, then your product is the interest rate and the loan. And if you give someone a total cost analysis and you show them options, you show them how those options perform over time, now your product is advice. It's an advice experience.
Right.
And
No, I
and
think that's absolutely right. And that's transparency. It's upfront and it helps that consumer make a better decision. I'll add one more point to this though. In terms of pull-through rate, conversion rate, it is a factor that lenders can take into account when they set the loan officer's compensation. So those loan
mm,
officers with low conversion rates can be set at much lower compensations if a lender is willing to do that than those with higher pull-through rates. Or you can, effectively bonus someone based on their pull-through rates.
so by the way, guys, big takeaway for any C-suite leader looking this, the best way to help your loan officers right size comp from what Mitch just told me is really understand what he just said. So call Mitch, figure that out, and start making conversion rate your top metric. Like, hey, you've got this leaderboard that shows how many loans people closed, how much volume they closed. How about we have conversion? And how about when I go to sales rallies, we start having an award for someone based off a certain level of production. Like if someone's closing 10 loans a year at X conversion, like what does that mean? But if someone's a sustainable, productive, closing 60 loans a year, who's got the highest conversion rate matters. And we should start recognizing that and measuring that. It sounds like you agree, Mitch. And
Oh,
there's even some ways we can compensate around that.
I completely agree. And this is nothing new, in all honesty. I mean, the lenders have had the ability to do this forever.
I don't think anybody does it.
The
I mean,
laws
does,
don't get in the way and don't stop you from doing it. And yes, yet it really is, one of the most important, if not the most important metric that you've got there. So
and
I completely agree with you.
Yeah, and for any loan officer that's getting either upset with me or Mitch around this point, I will tell you right now, if you start obsessing over your conversion, you make that your number one thing, you get your comp right, you will make more money. You will have a better sustainable career in the industry, and then you'll also become more valuable to realtors. So you may not like some of this, but I promise you, and I'll be happy to talk to anybody, you will make more money, you will be more valuable to realtors if you start focusing on conversion and consider that your number one metric.
Listen, it comes down to this. If you want to have a client for life, first and foremost, you have to have that client. They're not a client if you can't convert. They're just
Right.
not there. So get the client in. Conversion rates are really, really important. And then work on, your service. Have a client for life.
So before it's similar to this issue, but it sounds like, disparate pricing, disparate treatment, is still as big of issue as ever.
Mm.
And by the way, that's another thing. If you start thinking about your product is more than just the rate and fee, and you you get your loan officers delivering a mortgage coach experience, you'll it's a compliance advantage because you're showing transparency beyond the common experience. If you're standardizing that and you're delivering everybody that value, isn't there a compliance advantage to that,
Uh,
Mitch?
there's absolutely a compliance advantage to that. You're doing what's actually, you're not only doing what's right, but you're complying with the law itself. I mean, when you talk about disparate pricing, for example, and disparate treatment, something that you just raised, number one, that will always be an issue, quite frankly. And when you think about it, in terms of disparate pricing, it comes about generally as a result of the amount of discretion that's given to the loan officer. Okay. And it may not be total discretion. The loan officer may have to, in fact, go back and get approval for pricing concessions and things along those particular lines. But disparate pricing means that you're applying your pricing concessions in a manner that's disproportionate, disproportionate and adversely affects protected groups. So in other words, put it in plain language, okay? You have a white borrower, you have a black borrower, and the white borrower you end up having a discussion with, and you're lowering your price, you're exercising discretion, and the black borrower, you're not doing that. That's disparate pricing. That's also disparate treatment itself. Those areas of fair lending, they're not going away. They are enforced on multiple levels by the CFPB, by the Department of Justice, by the Department of Housing and Urban Development under the Fair Housing Act, by virtually every state banking authority in the country as well, and by state AGs. So you have to think about that. And if you say to yourself, listen, I always, I'm in the business of making loans, and I hear this all the time, and so I'll make a loan to anyone that comes in the door. That's not the point. The point is, are you consciously or are you subconsciously pricing differently, among groups? And it's important to watch for them.
And for every mortgage professional listening to what Mitch just said, I've interviewed over 1,000 top loan officers. And the one thing they all have in common when you're playing at the top is they have a process in which they serve a consumer and they are consistent with that. They're not like guessing, is this person going to shop me? Is this person not going to shop me? No, they've got a best practice way of delivering value and price, and they're consistent about it. So, disparate treatment is really just not being consistent with a high quality experience. So it's not good for conversion. It's not good for your career. And it's clearly, not good from a compliance perspective. Yeah. All right. So let's, another topic that literally everybody wanted to get just kind of an update on NAR settlement, anything that you think is big news in 2025. Just kind of an update on now that we're on the other side of it, but there's still a lot going on. The game is still being played. What should loan officers and IMB lenders beware of and know
So,
of?
and that's the important piece of it, because in terms of the NAR settlements, as you all know, that impacts buyer brokers on the real estate side itself, and it puts specific requirements on them in terms of meeting with their customer before they show them any property, and having a signed agreement that lays out what their compensation is, what the consumer is going to have to pay them, unless the seller later agrees to take that cost on for the buyer broker services itself. So, you take a look at that and you say, all right, this doesn't really impact a mortgage lender, but as you know, it really impacts you as a mortgage lender, as a loan officer. On a retail basis, your greatest source of loans typically are real estate agents and real estate brokerage companies and real estate agents themselves. So it has it has an impact. The impact is, not yet seen, in all honesty. A lot of people say, okay, so the NAR settlement, the terms were implemented and so far everything looks good, looks the same. It's not going to stay that way. It will not stay that way. Over time, that market will change. Buyer brokers will in fact have a lot more negotiation that on their fee and on their price, because discount brokerages will step in. And once you sit down with a consumer and you say, you're going to pay me 3 points, and a discount brokerage steps in and says, you're going to pay me 1 point, and I'm going to provide these services for you, you're going to see that taking hold in the marketplace itself. So it's going to impact where you're going to get your business from. It's going to impact your relationship with the buyer agent. So I say buyer broker, but really I mean buyer agents. It's going to impact, your relationship with them. And, what's the best thing that you can do to assist buyer agents? Number one, educate your consumers. Educate your own clients about the importance of their having their own agents. And it is important that they have their own agents, okay? They need someone on their side. They need someone that knows and understands the market itself, and they need someone to help negotiate their particular deals. Educate them about the importance so that consumers don't look at this and say, well, I can go cheap on this, when in fact, maybe that's not the right party. And you educate them, you're going to be helping your buyer agent relationships and your referral relationships, quite frankly. You're going to help them out quite a bit. The next thing that's really important, but besides just educating the consumer and letting them know how important it is that they do the right thing with a buyer agent, is the next thing along those particular lines is making sure you're providing service. Okay, that agent's going to look good, and that agent's going to get business, in large part, not just because of its own service, but because you actually made it happen and you had the loan go through. That's why they're going to look good. So the best service you can provide to the consumer, and that goes to the issue of conversion or pull-through rates as well, quite frankly. The best service you can provide that leads to you're actually closing on that loan and leaving that consumer happy is the best help that you can provide to these buyer agents.
So my takeaway from what you just said is we're still in the first or second inning. So the game is just getting started. Like, don't draw any conclusions. And then be a conversion partner, and education and advice is how you can best serve an agent, because the battle will be on in 2025.
Oh,
I
yeah.
interviewed Tom Ferry a couple months ago. He said, like, it's going to play out over the course of a year or two, and he called that before the NAR settlement came into play. I interviewed the number one realtor in America. All the top players, expected this. I interviewed the number one buyer agent, Ken DeLeon, on this topic, and they're like, don't think like a month, 2 months, even 6 months. Like, the game is just getting started, and if you are an executive, don't think like, oh, I need to take my eye off the ball. Like, you need to, if you made conversion your number one priority, you'd win with borrowers. You'd save money on credit reports, because you would have more closed loans for credit reports and disclosures, and then you'd also be preparing your loan officers to be more valuable to real estate agents, and they need you to be more valuable. Anything before we move to the next question on that?
No, I agree with what they were all saying. And the reality is, as it pertains to the changes that are being made based on the NAR settlement, we're in the top of the first inning. This is
All
going to
right.
play out over quite some time.
Any trends, anything you're seeing around the corner on JVs, MSAs, and just controlled business relationships between mortgage and real estate?
Well, I think
Anything?
the industry in general, the lending industry in general, and those that get into these arrangements are very aware of compliance risks. And so I do see, a much better quality of JV being formed today than we've seen in the past. I see the JV with its own employees. I see the JV, being able to run its own business. And all of those things are obviously really important. MSAs as well, although I will tell you, I see a lot less MSAs than I do JVs, in all honesty. I don't mean numerically. I just mean in terms of the interest that's out there and what others want to jump into. Listen, a JV with a home builder is fantastic. It could be a fantastic opportunity, quite frankly, because most consumers of that home builder is going to go to that home builder's affiliated company. That's been
Right.
established over years itself. A JV with a real estate brokerage company, not so much so, because the broker can't necessarily control what their agents are going to do. And you know what it's like with local agents, they have their own people and they like to send them to them. That's the nature of their retail practice that most of the loan officers that are part of your community, know and understand itself. So I don't see more challenges to it, or many more challenges to it, especially with a change of administration, quite frankly. And you know, I see more and more JVs being formed, and I think that's fine as long as they're done the right way and compliant.
Yeah. And I have a lot of clients that have those relationships, and I would just make the case again, conversion, uh, you know, is the key metric. Like if the loan officer in that JV has great conversion, they're going to have trust, they're going to be valuable, and it will help you have a more compliant and a more valuable JV or, whatever it is, MSA, whatever that business relationship is. If you're measuring, we talked to someone, we ran a credit report to someone, did we actually close a loan for them? That is a health metric. And obviously it will also become a profit metric. All right, so I think Mitch and I have pretty much made the case that conversion matters. And when it comes to improving profitability of your loan officers, more gross margin, less price concessions, it matters. It could be an extra 10 basis points, 20 basis points. We have the data to prove it. And it's good for compliance too. So let's just take a look at what you're delivering right now. What are your loan officers delivering? If they're delivering a fee worksheet, here's your rate, here's your payment, here's your cash to close. That is a commodity experience. Absolutely, they need to provide disclosures, but disclosures are not great tools for conversion. A mortgage coach experience, showing graphs and charts, cost over time, showing people how to build wealth with real estate, getting them excited about what it means to own real estate over 5 years, over 10 years, and then giving them options. Like this is a great example of a mortgage coach experience where the loan officer is showing, hey, option A, no cost. Option B with 2 points. And you know what? You can refinance in the future. It's never been more important to give consumer options, future cast those options. It will improve conversion. It will raise your profitability. You could literally increase your profitability by 50% if you can get your loan officers doing this. Hope this helps. Let's get back to Mitch. One more question, and then we'll also go into some closing thoughts. But I got a lot of folks that just want an update from Mitch on the credit trigger legislation, and just being predictive. I mean, Trust Engine, while we are probably with our sales boomerang product the biggest provider of that, we've worked really hard to be predictive with credit and non-credit data, so that we can even predict purchase opportunities and refinance. So we're kind of indifferent to what happens. But what do you think is going to happen from the
Yeah.
the
Well,
the legislation?
so let me just say what you guys are doing, based on your description there is right. It's absolutely right. It's got to be predictive in nature based on the data that's out there. The credit trigger alert legislation that's out there, do I think it will pass and get signed into law? I do. I do. I think we will see that legislation go through. And and really it's not meant to address so much, predictive analytics. It's meant to address the situation where every time you see or the credit bureau has an inquiry from a mortgage banker, they send out the trigger lead that you asked for. And consumers are being overwhelmed. Originally, both regulators, legislatures, and the industry thought credit leads were going to be great and good for the consumer because then they're going to have choices and they can shop around and do things along those particular lines. But what's happened is just a feeding frenzy, in all honesty, and consumers are overwhelmed by lenders every time they go seek a mortgage loan, and it shows up. They show up on their credit report, by a lender, running credit on them. So it's a big problem. It's a big problem. It's very different than predictive analytics, unless you want to just say it's predictive in the sense of, if someone's running a credit report on them, these guys are obviously looking for a loan. But that's very simplified approach that's overwhelming consumers today. Predictive analytics as to who may be looking, why they may be looking, things of that sort, and approaching consumers that way is going to get even more fine-tuned than it is today. You're going to see that operation grow along those particular lines, and it's going to get even more sophisticated than it is today as time goes on. Trigger leads, just straight out trigger leads, tell me who's been looking for a loan. Not so much so. I think the legislation will go through. I think services will be able to protect their portfolio. They'll be able to get that particular information, but otherwise, I think it's going to end up being pretty limited.
All right, everybody. I think it's really clear that we need to go beyond credit triggers. And even when legislation does change, if it changes, how can we use non-credit data to be more valuable to realtors? And how can we use it to be more valuable to our database? So we have the Trust Engine app, and it's monitoring your database for eligibility and propensity for both refinances and purchases. So literally at the very top, we've got some credit inquiries. Maybe as many of you won't have those in the future. But you know what we also have? We're using credit data and non-credit data. Oh, it looks like a move-up buyer here. Looks like a first-time home buyer. Looks like a move-down buyer. You click on that, and your loan officers can call, text, email. We're telling them, advice, what to say, and we're actually giving them scripts, what to say if you call, what to say if you text, making it easier than ever to go from data to needs of consumers. And guys, it will improve loans. It will be a competitive advantage with realtors when they need it most. Look, realtors need loan officers to be conversion partners. So between giving advice with price and being predictive with data, it's everything you need to win in this market. If you want to learn more, go to trustengine.com, upper right-hand corner, request a demo. We'll put a link to a demo down below. If you want to learn more about Mortgage Coach or Trust Engine includes Mortgage Coach. Get a demo, and we'd love to show you more. Let's get back to the show. And here's the philosophy that I would get every executive and every mortgage professional around, that the goal in using data is to just be more valuable to the consumer. Use data so that you can identify the need of the consumer, and then use data so that you can educate that consumer based off of their equity, their debt. There's never been more equity in America. There's never been more debt in America. How can we help consumers achieve homeownership, but achieve homeownership with financial freedom? And if you're using data to help people achieve financial freedom faster, save money, optimize debt and equity, I think you're going to be good in the long run. You agree with that, Mitch?
I absolutely agree with that. That's absolutely right.
All right. So any closing thoughts? Anything you think we've left out that you think whether it's a loan officer, a branch manager, a head of production, anything you want to close out with?
Well, I think we covered a lot. I think I would close out along these lines. With a change of administration, there's going to be a change of attitude as it comes to both regulations and even enforcement to a certain extent. But, branch managers, loan originators, loan officers themselves should not take that as a message that says, okay, they're getting off my back, so I can now do things that otherwise have laws that govern it and, could be rendered unlawful, because there are so many others beyond the federal government itself that is looking for you. I have heard, from through my clients, I've had branch managers, I've had loan officers that have said to me the laws are getting in their way of their being successful and originating these loans. And the reality is they're not. They're really not. The things that we talked about today in terms of conversion rate, okay? If you don't have a good conversion rate, it's not because of the law. It's basically because of your practices. And those are the things that can improve, your ultimate, your pull through, your financial success, and your success in the industry in general. So don't look at the laws as something, and don't look at a change of administration that says, okay, they've opened the door for me to do something you ought not be doing. That's not what this is all about over here. Do the right thing, treat the consumer the right way, educate your consumer, hold their hand, be there for them, pull through, close that loan, and you're going to have a consumer for life. That's really the answer here. It doesn't lie in compliance. It lies in your service to that consumer. I mean, it lies in compliance to the extent that you should comply, because compliance is good service.
All right, so here's my closing thought, guys. There's a little 2-minute video that I'm going to put down below in show notes. It's called the Mitch Kider Power of Homeownership Story. And here's the deal, guys. We're in the best industry. Like, I am so blessed to have found this industry in my 20s. And if you're doing the right thing, and you're not just focused on the 30 to 90 days that you find a lead till you close a lead, and you're focused on the 30 to 50 years that you can serve that consumer achieving the American dream, which is getting into home ownership, building wealth, achieving financial freedom, life is going to be great. Use data to do that. Use data to present a consumer their personal goals, their personal stories, and we're going to have a great career. So it sounds like 2025 is going to be pretty good in the mortgage business, at least from a Mitch Kider perspective. And if you have any questions, I especially hope that executives that you wanna help your loan officers right size comp, measure, conversion, gamify it, and then talk to Mitch around, hey guys, how can we do this in a way that will actually be more compliant and incentivize loan officers to improve their conversion. I hope you reach out to Mitch. Mitch, thanks for your service to our industry. Thanks for always making time to lean into this community. I appreciate it, brother.
All right, it's my pleasure. Thank you for having me.
All right. If you have not already followed our YouTube channel, subscribe today. We're going to hit 25,000 subscribers any day now. So give us a subscription, share this with your executive team. Executive team, share this with your loan officers, that you're trying to get to do the right things. Forward this to your loan officers, get them to watch it, and have a great day, everybody. This is a wrap.